Welcome to the deep dive. So there's some pretty interesting news that landed on August 4th, 2025. So we've got people talking in the real estate space, especially about, the future of places where we shop, eat, hang out. We're talking about Simon, the big S&P 100 real estate investment trust. And today our mission is simple. We're doing a deep dive into their latest results the second quarter of 2025. We're going to unpack the financials, their big strategic moves, and what it all means for the future for them in this sector. Basically give you the clear picture. And just so you know, everything we're discussing comes straight from their official press release. Okay, so let's get to these headline numbers first. Simon's put out their Q2 2025 results. This is for the period ending June 30th. And when you stack them up against last year, there are some noticeable changes. Net income, the part that goes to common stockholders, well, that went up. It's now $556.1 million or $1.70 per share. Last year, it was $493.5 million, $1.51 the share. Then you've got funds from operations, FFO. Specifically, real estate FFO, that rose 4.1%.
It's a $1.154 billion or 3.05 per share. Our overall FFO figure is also up, hitting $1.189 billion. That's 3.15 per share. And importantly, net operating income, NOI, for their domestic properties, that increased 4.2%. The whole portfolio NOI up 4.7%. So looking at all that, what's the immediate sort of headline for you? What does this batch of numbers tell us about Simon's, its current health?
Yeah, I mean, the first thing that jumps out is just how clear the underlying operational strength looks here. For any REIT, a real estate investment trust, FFO, funds from operations, and NOI, net operating income, those are really the heartbeat. They are non-GAAP measures, true, which means they're not strictly by the standard accounting playbook, but the whole industry uses them. Why? Because they kind of cut through the noise. They show you the actual cash being generated and how profitable the properties themselves are. Seeing those numbers up across the board, especially that 4.1% jump in real estate FFO, it tells you their properties aren't just surviving, they're actually making more money. It's a really strong signal. Shows fundamental resilience, I'd say, especially in today's market.
That's a great point, distinguishing between the, let's say, accounting figures and the actual operational reality. Okay, so let's zoom in there on the operations. Beyond those big FFO and NOI numbers, the day-to-day stuff happening at their U.S. malls and premium outlets, that tells a story too, right? We saw occupancy as of June 30th was 96.0%. That's up slightly, just 0.4% from 95.6% a year ago. Still moving up. And the rent they're getting, the base minimum rent per square foot, that increased too, to $58.70 from $57.94, about a 1.3% rise. Plus, they reported retailer sales per square foot is $736 for the last 12 months. When you look at those metrics, which one really jumps out as like the key driver of success at the property level? Or is it the combination?
It really is the combination, but if I had to single one out, that occupancy rate hitting 96.0%, that's huge. In retail real estate, having your properties almost completely full, that just screams strong demand from tenants. And even that small uptick, the 0.4% increase when you're already that high, it shows they're not just holding on to tenants, but maybe even adding a few. It's positive momentum. Then seeing the base rent per square foot go up alongside that, that's also really significant. It means Simon can actually charge more for their space. Their locations are desirable. People want to be there, even in this, changing landscape. And that flows right to the bottom line.
Right. So they're full, and they can charge more because the tenants see the value. Makes sense. And the $786 in retailer sales per square foot, what's the significance of that number? What does it tell us about the tenants?
Exactly. And that 736 figure, that's your window into how well the tenants are doing. Are the stores inside Simon properties actually succeeding? Strong sales like that suggest, yes, they are. The businesses are thriving. And that's critical, right? Because if tenants are doing well, they can pay their rent, they're more likely to renew their leases, they stay long-term partners. It creates this positive feedback loop. It shows these aren't just spaces being filled, they're actually vibrant places where commerce is happening successfully, revenue-generating hubs. And, beyond just the numbers from the properties themselves, Simon's bigger strategic moves and their overall financial health really paint a picture. It shows a company that's actively shaping its future. Take that acquisition in Miami, Brickell City Centre. They bought out their partner's share in the retail and parking there. Now it's wholly owned. That's not just about, consolidating the financials. It gives them total strategic control over a really valuable asset. More flexibility for what comes next there.
Okay. So full control over a prime piece of real estate. And like you said, doubling down on its potential. And what about their activity in the capital markets? They did 21 secured loan deals totaling around $3.8 billion. Can you unpack that a bit? What are secured loan transactions exactly, and why is doing that many significant?
Good question. So secured loans are basically loans backed by collateral. In this case, Simon is pledging specific properties as security for the loan. This gives the lender more security, which usually means Simon can get better borrowing terms, like a lower interest rate. The fact they did 21 of these deals, adding up to almost $3.8 billion, shows two things. One, they have valuable assets lenders are happy to lend against. And two, they're actively managing their debt, refining it, maybe extending maturities, getting the cash they need. And they mentioned the weighted average interest rate on those was 5.84%. That gives you a sense of their borrowing costs, which is, always a key factor for a REIT. And then there's their liquidity, which is frankly massive, around $9.2 billion as of the end of June. That breaks down into $1.8 billion of actual cash sitting there, plus another $7.4 billion they can draw down immediately from their revolving credit lines.
Wow, $9.2 billion in liquidity. That's $7.4 billion in revolving credit facilities. That sounds like having a huge credit card ready to go. What does that kind of financial firepower let a company like Simon do?
It is. It's like having an enormous, very flexible safety net and opportunity fund rolled into one. That much liquidity means, well, freedom. They can jump on strategic opportunities like that Brickell deal without scrambling for cash. It means they can easily handle bumps in the economy, manage day-to-day operations smoothly. There's no financial stress there. And that confidence, it flows through to shareholders too. Look at the dividend. They just announced another increase for the third quarter. The common stock dividend is going up to $2.15 a share. That's almost 5% higher than last year, paying out more cash to shareholders. That's management saying, we're confident in our earnings, our cash flow, it's sustainable. All these moves together, the acquisition, the debt management, the liquidity, the dividend boost, they really position Simon strongly for whatever comes next. Growth, stability, it covers both.
Okay, so the picture is pretty clear. Strong performance on the ground in their properties and some really solid strategic and financial management backing it up. But, like always with these reports, sometimes you dig a bit deeper and find nuances, right? I notice when you look at the full 6-month picture, so it's January through June 2025, and compare that to the first 6 months of 2024, some numbers look different. Specifically, net income and the overall FFO for the 6-month period were actually down compared to last year. How does that square with the strong quarterly results we just talked about? Can you walk us through that?
Right. That's an excellent point, and exactly why context is everything when you read these reports. The reason those 6-month numbers for net income and overall FFO look lower year over year, it's almost entirely down to a big sort of one-off item from last year. See, in the first 6 months of 2024, Simon recorded a very large gain, $414.7 million, to be precise, from disposal, exchange, or revaluation of equity interests. Basically, gains from selling off assets or having their value reassessed upwards significantly. Now, in the first 6 months of this year, 2025, they also had a gain from similar activities, but it was much smaller. Only $80.5 million.
Okay. So last year had this huge non-recurring gain baked into the first half numbers, making the comparison look skewed this year, even if the core business is doing well now.
It's exactly that. That massive gain in 2024 inflates the prior year's GAAP net income and the overall FFO number, making this year look lower by comparison on those specific lines. But, and this is the crucial part, if you look at the core operating measure, that real estate FFO we talked about earlier, for the 6 months, that actually grew. It went from $2.191 billion in the first half of 2024 to $2.268 billion in the first half of 2025. So the underlying business performance is still showing growth over the 6 months. It perfectly illustrates why focusing on metrics like real estate FFO is so important for REITs. Narrate, the industry body, defines it specifically to help investors see past those non-cash items like depreciation or these big one-off gains from sales and get a clearer view of the ongoing operational profitability.
That makes total sense. It's about separating the kind of windfall gains from the steady, ongoing business performance.
Got it. Okay, so pulling it all together then. Based on this strong quarter and their view of the rest of the year, Simon has actually increased its guidance. They're now expecting real estate FFO for the full year 2025 to be somewhere between $12.45 and $12.65 per share. And their estimate for net income per share is now in the range of $6.63 to $6.83. What does raising guidance like that signal? How confident are they, and what sort of factors are likely baked into that optimism?
Raising guidance mid-year, that's a pretty strong signal of confidence for management, absolutely. It tells you they're looking at their current performance, the trends they see in occupancy, rent, tenant sales, the impact of their recent strategic moves, and they're feeling positive about the trajectory for the rest of the year. They're essentially saying, yeah, we think we're going to do even better than we initially thought. Yeah. Of course, you always have to temper that with the standard caveats, right? Forward-looking statements always carry risks. Things like, how competitive the retail market stays. Can they keep renewing leases at good rates? What happens with the broader economy, inflation, recession fears, that sort of thing. And Interest rates are always a big factor for real estate, but even acknowledging all those potential headwinds, the fact that they are raising guidance, it definitely indicates a very positive internal outlook right now.
Okay, so let's do a quick wrap up. Simon's Q2 2025 results, they really show a company with strong operational momentum. We're seeing occupancy up, rents are climbing, tenants seem healthy based on sales. Combine that with smart strategic moves like taking full ownership of Brickell City Centre and a very solid financial position. It's all led them to boost their forecast for the entire year. It's quite a compelling story they're telling about their place in the real estate world right now, which kind of leaves us with a final thought to chew on, doesn't it? Given this consistent positive performance from Simon, especially when we hear so much about the challenges in the retail sector, what does it really tell us? What does it say about how physical places for shopping, dining, entertainment are maybe evolving? Are they proving more resilient than we thought, perhaps as these essential community hubs? And how might Simon's ongoing investments continue to shape what those physical retail and social spaces actually look like for all of us in the future? Definitely something to think about as you go about your day.